Welcome to the Just Word Podcast. I'm Pat Bolland. The Just Word Podcast is brought to you by Justwealth, investing the way it should be, just for you. Here at the Just Word Podcast, we've been talking about retirement and accumulating assets ad nauseum, really, but we never talk about rolling that out and getting rid of those assets and using them to their best advantage. And that's really quite important. So we're going to be joined by Ian Moyer, coming right up. Ian, a real pleasure to meet you.
Great to meet you, Pat. And I've seen you different places, but great to chat to you directly.
I get around, as they say. You're still in Ingersoll, I see, and founder of Cascade Financial Solutions. Well, what does Cascade actually do?
Cascades is a retirement income planning software that helps people do what they need to do in retirement to make sure that they're paying the least amount of tax that they can, and draw down the money that they've saved 50 years, 40 years to accumulate.
Yep. And that's what I want to talk to you about, because I saw your article in Findependence Hub, and there were 4 retirement planning mistakes that people make. Expecting the government to look after you, and I'm talking about OAS and CPP, those kinds of things.
Right.
Applying for benefits too early, spending too much too soon, which is easy to see. You're retired, you want to go on a ship somewhere around the world. But here's the thing that I think is really important: paying more tax than you need to. I mean, 3 of those things are common sense, but nobody talks about the tax component. Why do you think that is?
Well, it's an interesting point, what you're saying about common sense, because sometimes common sense isn't that common. And the aspect about people spending money too early is, when you think about it, you spend more money on the weekend or during the week. And when you think about it, every day in your retirement is a weekend. So that's when you spend more money. And to your last point about the aspect of when do you take the money, that's all happens within Cascades to help an individual figure out when they should be taking the money, how much they should be taking, and determining how much tax over their retirement years they're going to be paying.
Okay, let's just start with those government benefits, because that's where the article actually started. And they talk about CPP, and whether you take it at 60, 65, or 70, how much of a difference does it really make? Can you run me through an example, for instance?
Yeah, well, it's really based on a percentage. So every year you defer, the percentage goes up, and you get a bit more. So it isn't just at 60, 65, and 70, it's every year in between. Mm-hmm. And that percentage goes up. So the more that you defer, the more it goes up. Let's take the example of old age security. It actually goes up a little higher. It goes up 7.2%. And the reason why that one's important is because some people fall into the category of having old age security clawback. If they're making over $81,000 a year, which I know seems like a lot, but if an individual is making more than $82,000 a year, the government starts to claw back that old age security. So maybe by deferring it, sometimes in the early years, people will have higher incomes than they will later on. And there's a number of reasons for that. One reason could be they sell a cottage at age 66. That capital gains comes into play, and therefore they lose their old age security for that 1 year. And if it's a couple, both of those individuals, if they've joined ownership in the cottage, could lose their old age security. And you may say, well, that's only $16,000, but it's interesting that to the client, that's their $16,000.
Mm-hmm. Yeah, good point. Okay, other than selling your cottage, or working older, I guess, there's really only a few places where you can get income, and that's from the plans that you put together or the benefits. So there's government benefits out there, CPP, old age security. Then there's the registered retirement savings plan. There's the tax-free savings account, and then there's either a personal pension or there's savings that you put together. Is that a fair kind of a comment?
Yeah, but each one of those, if you think of non-registered, you could have interest, dividends, or capital gains from those non-registered accounts. And each of those are affected differently by tax. There's a different tax rate for each of those. And another thing that happens is that dividends adversely relate to old age security. So the more dividends you have, because dividends are grossed up, they affect old age security more than interest or capital gains. So you have to kind of watch what type of non-registered income you're taking in retirement as well. Back to your point about pensions, there's actually two different types of pensions: defined contribution and defined benefit, and they're affected. They affect the tax rates differently as well.
So the sequence that you activate those things must matter a lot.
It matters, and the reason why it matters in retirement, there's a big difference. While you're working, the differences don't come into play. But in retirement, there's more deductions. You have an age deduction in retirement. You have a pension income deduction for each individual who has qualified pension income. So all of those things make a difference. Some things can be deferred and then there's no tax at death, like tax-free savings account. Other things like RSPs can be deferred, but there's a huge tax liability on death.
Okay, but generously, you let me try your financial services software. And I plugged in various scenarios: a 35-year-old, a 60-year-old, an 88-year-old, for instance, just to see how it worked. And
Yep.
almost in every case, the suggestion was that you wind down your registered plans first, like your RSP. Is that generally the case?
It's common, but it's not always the case. And oftentimes when we were developing this, we would sit around the table with different scenarios and trying to calculate, what do you think it would be? Do you think it would be registered first or non-registered first or tax-free savings first? And we'd guess. And if you're guessing at this stuff, you're going to get it wrong. So we always say, let the math do the work and determine. Sometimes we'll do a plan for someone and it'll say registered first. However, they'll say, well, yeah, but we're going to sell a business at a certain point, or we're going to sell a cottage, or we're actually going to sell a home and downsize and move into an apartment and do that. And then all of a sudden, a big lump sum of money comes into play, and that changes the perspective on the whole plan.
So your software can, I didn't try some of those scenarios like selling a cottage, but your software can accommodate that?
Yes, it can, by one-time deposits, one or many time withdrawals, or planning certain withdrawals for a certain phase of life. Let's say in the beginning, you want to have extra money for traveling the first 10 years, then that can happen as well.
You know, it's interesting. I have seen literature of late, and I got to admit, I haven't noticed it. In the insurance industry, there are all kinds of products that seem to be offered that you can contribute to and invest with, and then they give you back your money, in many cases, almost tax-free. What are your thoughts on a product like that, number one, and do you incorporate that into your software?
Yeah, we're working with a major fund company to introduce, a lot of them are called T-series, so that you're taking your capital out first, and then you're deferring your gains until a future date. Sometimes that future date is 15 years, sometimes it's 18 years. And we're working with them to be able to illustrate that either for or against in the person's situation. So whether it's useful for that individual to do that and then run it against maybe not doing it, doing something else.
Can anyone use your software, or is it only really for advisors?
So it's available for advisors for a monthly fee, but it's also available to the consumer for a one-time fee of $85, where they have a time period to use it. And that time period is currently 30 days. And they can run as many scenarios as they want during that 30-day period. So it gives them a real snapshot of what retirement is going to look like.
Okay, why would they just run it for 30 days and then say, see you later kind of thing? Do they need it on an ongoing basis?
Yeah, usually it gives them a snapshot. We're looking at, we had some feedback that people are wanting it for a whole year. they usually, what happens is they do their snapshot as they're getting ready for retirement, and then the following year they pay their money again, and they run it again to see how accurate they are as they get closer to retirement.
Yeah, but it seems to me you should do this at the very beginning. You should do it when you're 35 years old and say, hey, listen, I'm going to put $8,000 a year away in an RSP, and I should have this much accumulated by the time I'm 65, because that's when I want to retire. And your software kind of played into that a little bit, didn't it?
Yeah, exactly. And we're just trying to get the people that are getting that tsunami is getting towards retirement to use it, and then go from there. But really, the business owner that is 35 years old and has a corporation and wants to know, should they be taking dividends or salary, that all affects retirement, because that way, if you're taking dividends, you don't put money into CPP, or you don't put money in RSPs. So maybe it's important to find out when you're 35 years old how you should be doing that, and what you should be contributing. Same with tax-free savings account. They're new on the scene in the last 7 or 8 or 9 years, and now people are starting to accumulate money in that. Should a younger person put money in a tax-free savings or an RSP, or a combination, and what should that combination be?
Okay, ballpark, what should that combination be, or is it unique in every case?
It's unique in every case. It really is unique in every case.
Okay, walk me through a scenario then. Let's say I'm 55, 60 years old versus 70 years old, looking at your software. What do I need to know to complete the survey appropriately and get the right answers?
So the best thing, if somebody's sitting down to use the software, is to have the statements that the person gets, their quarterly statements in terms of what they have in those particular assets, whether it be their RSPs, their RIF, if they've started to take the money out of their RSPs, their pensions, when they start, if there's any wraparounds in pensions. A lot of time there's a wraparound around CPP, and that gets affected. They get a certain pension at age 60, but at age 65 it drops because they're getting CPP. So all those things should be taken into consideration. And of course, birth dates, and when they want to retire. Do they have any specific income requirements in the early years? Or we've been told a lot of people want to plan for money late in their life for proper nursing home care, and that can be very expensive. So, what does that situation look like? Nobody has a crystal ball, but if we can just start to plan out and then look at different scenarios, and have people's input into what they want, because really this is their retirement plan. It shouldn't be just something off the shelf. It should be their retirement plan.
Uniquely planned. Can I make in your software? Can I make provisions for holding $100,000 back for the nursing home, or holding, same kind of money back for estate planning and those kinds of things?
Yep, very much so. You can choose a desired income, or you can choose the maximum income. Sometimes somebody says, well, the software says that it'll give us 140,000 a year of after-tax money, and we don't need that much. Everything's paid for. The house is paid for. 120 would be fine. Okay, well, let's put 120 in, and then you'll determine what the estate value will be at that given point.
Oh, this may seem like a silly question, Ian. Why hasn't somebody done this before? I mean, why wouldn't the banks have this on their website, for instance?
There's been so much emphasis on accumulation, that this has just been left to the side. And when we started creating this software, I couldn't find anything in the market that would do this. There was nothing around that could do this. And the great thing about Cascades is it compares scenarios, as you saw. So it compares 3 different scenarios. So there was some software out there where what the advisor had to do was run the scenario 10 or 15 times. And some of these softwares are so cumbersome that it takes 2 to 2.5 hours to run a scenario. And if you ran 10 of those, they didn't have the time to do them. It would just be put aside, and they're saying, well, we're not getting any extra money from the client to do this, and we're not going to spend the time on it. So it was really left aside. The institutions were geared on the last 50 years of putting money in, or looking after the money that is being put away. And this has just been pushed aside. Now it's coming to the forefront because the great boomer tsunami is here. We're in the midst of it, and there's a lot going on with money needed to be there in retirement.
I did exactly as you just described. I ran several scenarios under the 35-year-old, two or three, and then I ran almost a dozen in the 60-year-old to see if I, paid myself differently and those kinds of things, how it would play out. And all of that took me 20 minutes, maybe 30 minutes. Now, I have a financial background, so that was a little bit easier. And I kind of knew the numbers off the top of my head of the value of my RSP, but I had 12 different scenarios sitting in front of me inside of 30 minutes. It was very easy to do.
And that's the line of complexity that we've tried to follow since we created this. Let's make it important enough that there's value there, but let's not try and make it too complex that it's hard to use. And I'm sure we've all received a manual if you've bought a snowblower or some kind of equipment or a stove or appliance or something. The chances of you reading that manual are greatly diminished by the size of that manual.
Oh, you've seen me shop at IKEA, have you?
Yeah, if it's a couple of pages long, chances are you'll glance through it. But if it's 40 pages, you're going to put it aside and you'll never look at it. So we want to make it accessible and easy to use.
Right, exactly. Well, thank you again for the opportunity to use that software. I found it very interesting. I hope the listeners to the podcast as well. Where do they go if they want to get more information?
So right to our website, Cascades FS for financial solutions.com is.
So hold on, there's a Cascades. So it's like Cascade, CASCADES, and then
ES,
FS. Okay.
Yeah. And then FS for financial solutions, those letters, and then .com. And go there and you can look at the different information on the website, and there's contact information on there as well.
Ian, thank you again for your time.
You're welcome.
Ian Moyer, he's the founder of Cascade Financial Solutions.